Land's End, June 3rd, 2020. Krim Delko, managing partner, Orange Capital Partners. The purpose of this podcast is to talk about what we're doing sort of on a weekly basis. It's not clear yet how often and how regular this will be, but the idea is weekly, but really more driven by whenever there is something interesting to say. This fortunately happens quite often in our business. So the idea of having like a podcast versus a blog or letters to investors is just to have a little bit more clarity and also verbal context in what we do. It's definitely meant to be a chronicle, so it's meant for people, customers, and anybody who's interested in following us to have a sense for what's going on with Orange Capital Partners. It's not a marketing material. In fact, if you hear this and you like us, don't call us to invest money. Find other channels. This is not a marketing purpose. This is not meant to solicit investors, and it's not advice for investing. So please take this with a grain of salt. This is our ideas that we debate, and the purpose of the podcast is not to sell investment ideas. It's to give people a sense for what it's like to run a hedge fund. The hedge fund industry is very, very confused. I think it's misunderstood. Hollywood has tried, business schools try. Nobody's able to explain it because it's a very unique type of business. It's exciting. I think it's the best job in the world because it gives you the ability to use your imagination and your creativity and fantasy and turn that into something skillful, or use that whole funnel of ideas, squeeze it into a machine of skills, know-how, experience, and then produce returns, make money. And making money, I think, is a very good thing because it allows you to do other things, at your discretion that I think make you feel better. And therefore, I think it's a good thing to be able to run a successful hedge fund. We were founded in 2008. We have since produced about 8% cumulative average annual return. So if you gave us $100 in 2008, you would have about $250 today. It's relatively pedestrian, but still good. And we are, I think, now at the cusp of starting to produce much, much better returns. And that's part of the reason why we think this podcast makes sense for people also in hindsight, then to have a better sense for what we were thinking and how we were able to achieve those returns. We are up 55% for the year. This number is not included in the 8% CAGR number because that number was taken and audited by the end of Q1 of 2020, and we've had since then. Actually, we're up about 52% or so. So for the year, we're up 55%. For the week, I'm recording this on a Wednesday. We made 8% this week. And the reason I'm saying that is just so you get a feel for how this works, how these returns come, and what it means on a daily basis. Trust me, we'll have weeks when the numbers will be negative also, and it's not always rosy. But I just want to have people a bit of a better sense for what it is like to be running a fund. Our largest position is Tesla. It's about 70% of the fund. We have 10% Microsoft, 10% Intel. We have 20% of a biotech basket of stocks that are mainly consist of companies that are involved in CRISPR technology and also gene sequencing, Illumina and Pacific Biosciences. So let's start with Tesla. Just quickly, what happened this week? There was a launch of SpaceX over the weekend. It drove up the stock on Monday, which has contributed to our pretty good return this week. There has also been some news on Tesla lowering prices. So we believe there is a little bit of a demand issue going on right now in the US. However, it could be offset by China and probably also pretty good demand around the world. Nevertheless, the second quarter is not going to be pretty for Tesla. I think that's almost consensus now. And the stock probably is elegantly neglecting that right now, and that's fine. Our CRISPR index has also done well this week because there was one deal. Intelia has struck a deal with Regeneron to do more research and get more money from them, and that has contributed about, that has driven up that stock by about 20%, and we have 20% of a CRISPR basket, which was up probably about on average about 10%. So we added about 2% of portfolio thanks to the CRISPR basket. Microsoft and Intel have been relatively flat. So this so much for this week. What are we thinking? What's the idea, or what is something interesting that we're contemplating? We believe that interest rates will not gonna go up anymore. Interest rates will stay flat or go down. And that has huge implications for the financial markets, because forever people have been modeling interest rates, and everything kind of starts with interest rates are sort of the particles of financial markets. So the same way, people model, electrons and quarks and whatnot to try to figure out how nature works. Interest rates are the elementary particles of financial markets, and because they can go up and down, they've always been modeled in all kinds of ways. Things like Markov models are being used, and the drift factors and stochastic variables are introduced into the models, because very simply it can go up or down, and therefore you have to think both ways, and volatility and uncertainty can be both ways. And now it's not the case anymore. I think because we have very large government debt, and the increasingly large government debt, this is just the beginning. Since Donald Trump took over, our deficit has ballooned, and now with the COVID-19 crisis, we have just tremendous amount of deficits, and which have to be financed on the federal, state, and municipal level. Government, companies, and governments are just indebted all through the gazoo. And if you have that much debt, you basically can't raise your interest rates anymore. It's not possible to allow interest rates to go up, or in fact, even if you wanted, you can't, because the moment your interest rates go up, the economy would come to a standstill, because servicing the debt would just cripple everything else. So this is kind of like a rabbit hole that the Fed and the financial markets have been pulled into, partly because of government spending, and then because of the crisis. It's a Japan scenario for the US, where we just continuously monetize debt, and therefore interest rates cannot rise anymore. So that's the idea. I don't want to go further right now. There's a lot to talk about what that means for bond markets. There are trade ideas around shorting, rates, or going long-term bonds. There are issues about the Fed doesn't want us to buy long-term bonds. Actually, because that would flatten the yield curve. So they don't want us to do that. So there's this whole conversation: should I go against the Fed? Maybe this time I can, because I'm actually playing a much stronger card than even the Fed can control, which is this whole debt overhang kind of issue, which is kind of, it's like you're really playing with gravity here, and the Fed cannot, even the Fed cannot go against gravity. But I don't want to talk about this. I just want to mention this one thing, that rates cannot go up. So with rates staying low, we are looking at a Japan scenario where we have very little growth and deflationary pressures everywhere. What to do in a case like that? There are several trades that I think make sense in this type of scenario. And the first that comes to mind is you want to invest in real growth. Real growth is growth that is not just inflationary type growth, because there is no inflation. You're not going to make any money with that. What I mean with inflationary type growth is, let's say, a typical company like, let's say, Coca-Cola, or a railway company, or utility company, or I don't know, companies like that. they just keep raising prices according to inflation, maybe a little bit more, a little bit less every year, and that's really their only growth. That is not going to happen anymore. You can't possibly make money in a low interest rate environment like that. So what you need is real growth. Real growth, I think there's a lot of definitions. My most favorite definition is real growth is when you create something a lot better for a lot less. When you're 10x better and 10x cheaper. Silicon Valley has been in this business for a long time. However, it's been mainly software type stuff, PCs, computers, spreadsheets, internet, Facebook, social media, all these things, and then Apple came with hardware. Actually, they gave us an unbelievable computer that is in our hands, and it's much better and much cheaper than what we had before. And now we're looking at other types of investments, and Tesla is one of those. Tesla is giving us access to energy and transportation, which is sustainable and also much, much more efficient and less costly than alternatives. So they're attacking a gigantic market with new innovative technologies. And to borrow a phrase from ARK Invest, it is technologically driven disruption. Disruption as defined as something that is creating a whole new market, either within an existing space or even it's just creating a new space where there has not even been any demand before because it didn't exist. So Tesla is one of those companies. We think that real growth along those lines will generate not just very high returns, but given that the rates are low or almost zero, the demand for assets like that will exceed way, will be much, much stronger than any kind of existing financial model would predict. In other words, you will have continuous chronic overvaluation of these stocks because they're really not overvalued. They're only overvalued relative to models of the old world where interest rates could go up also. And if interest rates only can go down, these types of assets are very, very valuable. That's the idea of the week. I think I'm happy to include more thinking along those lines in my next podcast. But this is it for now. Thanks.